Good evening, learners. Mwalimu Raymond Nzao. Today I'm taking student through public finance and taxation. Public finance and taxation is in intermediate level. We are going to discuss chapter 7, taxation. At the end of chapter 7, the learners should be able to define the term tax, types of taxes in Kenya, classification of taxes, tax shifting and factors that determine tax shifting, principles stroke canons of optimal tax system, types of tax systems, single versus multiple tax systems, tax evasion and tax avoidance, taxable capacity and budgetary and fiscal policies. So I request learners to subscribe to my page so that when I release a new content, you can follow. Welcome all. We are going to start with the definition of the term tax. What is tax? Tax is a compulsory contribution of the wealth of person to the state, which is incurred for the common goods or interests of all people without any reference to any special benefit conferred to the taxpayer. Then we move to the characteristics of tax or features of tax. It is a compulsory. Thus, it is a criminal offense for any person who does not pay taxes. It is imposed by the government against the residents of a country. Then we move to the functions of the state concerning taxation. We have protection or security. The government should provide security to the residents. We have administration. The government has various ministries, departments, and counties to ensure there is order. Social function. The government should provide education, healthcare, housing, entertainment, etc. Then we have development function, like the infrastructure. We have seen the Thika Superhighway, the Express Highway, Maua, Dual Carriage, Kitui Kibwezi Road, etc. Then we move to sources of public revenue. We have tax, fines, donations, borrowings, etc. This chapter is highly tested by the examiners, and I will give you questions which have been set in previous sittings. Then we move to the purposes or objectives of levying taxes. We have to generate public revenue for economic stability. Taxes are imposed with the objective of stabilizing the economy. During inflation, taxes can be imposed to reduce the money in circulation. We have protection policy. Taxes can be imposed to protect the local industries against unfair competitions. For example, we can impose high taxes on mitumba importation so that we can protect the local industries which manufacture clothes locally. Long time ago, the clothes were being made of cotton, which was being planted in Kisumu, Kitui, but of late the companies, they are not operating. Social welfare. Taxes are imposed on harmful products to discourage their consumptions. I say like cigarettes. Now a cigarette, I think it is 10 shillings or 15. So the government can impose high taxes so that Kenyans avoid smoking, because smoking is harmful to the health. Then there is creation of employment and provision of infrastructure. When we impose high taxes, we get money to build infrastructure. We can now move to the canons or principles of taxation. And we have several, around 8 of them. One of them is the canon of equity. Every citizen should pay taxes according to their ability to pay. If I earn 100,000 and another person is earning 20,000, I am supposed to pay high taxes. Another principle or canon. We have the canon of convenience. Taxes should be levied in the most convenient manner. Another one, canon of certainty. Another one, canon of economy. A good tax system should attain economy in two ways: economy of collection and economy to the taxpayers. On the economy of collection, the cost of collecting the tax must always be lower than the tax or the revenue collected. Under economy to the taxpayer should afford to pay all the taxes and have sufficient cash left with him to cater for the consumption, savings, and investment. Then we move to the canon of productivity. A tax should be productive in that it should generate more revenue to the government. Canon of simplicity. A good tax system should be simple to the taxpayer to understand. Canon of diversity. A good tax system should be diversified. This encourages equity and generates more revenue. Lastly, canon of elasticity. A tax should be elastic in that the government should be able to adjust tax rates depending on the revenues required. Then we move to something else: impact, incidence, and tax shifting. This question, examiners have tested students in several settings. Learners should be able to define what is impact, incidence, and tax shifting. We'll start with impact. Impact is the first point of contact of the tax with the taxpayer. It is on the person who has the legal responsibility of paying the tax. Then we move to tax incidence. This is the economic unit that carries or bears the tax burden. It is the tax resting point. Then we move to tax shifting. It's the process of transferring the tax burden from one person to one person or economic unit to another. There are two aspects of tax shifting. We have forward and backward. Under forward tax shifting, we say this is where the tax burden is transferred to the customers or consumers. Then we move to backward tax shifting. This is where the tax burden is transferred to the suppliers or factors of production, e.g. by reducing the wages or the buying price of raw materials. Then we move to theories of tax shifting. We have concentration theory, diffusion theory, and demand and supply theory. We start with concentration theory. This is a classical theory that assumes there is an economic sector with a surplus. Any tax imposed in all sectors is shifted to the sector with a surplus. The taxes are concentrated in the sector with a surplus. Then we move to diffusion theory. it is impossible to trace the final incidence of a tax since it is difficult to the economy through constant transaction and interaction of various sectors of the economy. The theory is based on the following assumptions. Markets are efficiently competitive, and there is free flow of information. It does not matter where the taxes are imposed for the first time since they are eventually diffused in the economy. Factors of production can move from one sector to another quickly, easily, and without any additional cost. Then we move to supply and demand theory. This states that the taxes can be shifted from through transactions and revision of prices. The revision of prices is determined by relative elasticity of demand and supply. So learners, you should revise on those theories. Then we move to factors influencing tax shifting. We have elasticity of demand. Where the demand is elastic, the tax can be shifted backward or absorbed by the traders. Then we move to another point, elasticity of supply. Where the supply is elastic, the tax can only be shifted forward. Point 3. Time available for adjustment. The person who has time to adjust, either the trader or the customer, will shift the tax burden. Tax rates. Where the tax rates are very low, the tax burden is borne by the trader. Whereas where the tax rates are high, the tax burden is shifted. Nature of the markets. In a competitive market, the tax burden can be absorbed by the traders. In a monopoly, the tax burden is always shifted to the customer. Another point, government policy on pricing. Where the government has a price control mechanisms, the tax burden is absorbed by the trader. But where there is no price control, the tax burden is shifted. Another point, nature of tax. Direct taxes cannot be shifted, while indirect taxes can be shifted. Another point, geographical location of the tax. If the tax is imposed in a certain region, the trader carries the burden, since if it is shifted forward, the customers can move to the regions with no tax. Then we move to classification of taxes. Taxes can be classified on the basis of tax rates. Under tax rates, we have progressive, proportional, regressive, and digressive. Another classification under administrative and collection procedure, we have direct taxes and indirect taxes. Under tax base, we have output, income, expenditure, and wealth. So the learners, I will give you an assignment. You go and do a research on that. Then we shift to another subtopic that we can save on time. So learners, after you have done the research, should come up with the advantages and disadvantages of those taxes. So I'm going to take you through tax capacity. What is a tax capacity? It is the capacity of a country or the potential of a country to generate revenue in the form of taxes. Then we move to factors that influence taxable capacity. While the population of a country, the higher the population, the higher the taxable capacity. Employment levels. The higher the employment levels, the higher the taxable capacity. Availability of resources in the country. The level of education of the taxpayers since they can be able to comply with the tax regulations. The level of economic development, and finally, the popularity of the government or the psychology of the taxpayer. Then we move to another point, fiscal policies. These are policies used by the government based on tax, revenue programs and expenditure programs to achieve economic objectives and reduce undesirable effects in the economy. The following are the policy objectives for developing countries like Kenya: to increase the level of employment, to attract foreign and local investments, to promote accountability in public finance. So learners, you can go to Google and read more about the third world countries, or you research or you type IRD 200. It is a unit which is taught in university second years. State development and society. You will get more about developing countries, their features, and how their leaders operate. We learn more there. And still you can learn about budgetary policies. So that is the assignment, and next class I'll give learners the questions which have been tested in this chapter, and we discuss on chapter 3 in the next class, oversight functions in public finance management, where I will take learners through the role of Parliamentary Budget Office, the role of Auditor General, the role of Internal Audit, the role of Controller of Budget, the role of Public Sector Accounting Standard Board, the role of Senate, responsibilities of the Senate Budget Committee in public finance matters, the role of National Assembly, responsibilities of the National Assembly Budget Committee in public finance matters. That is what I will discuss with students and give them the questions as we prepare for the July 17th CPA examination. I wish you a good night and sweet dreams as you sleep. Let's meet tomorrow, and I request you to subscribe to my YouTube channel at Mwalimu Raymond Zao, so that when I post something there, you can check. I will be posting content in public finance and taxation, company law, auditing and assurance, quantitative analysis, and advanced financial management. Students have requested me to take them through the advanced financial management, which is one of the hardest unit in CPA. Those who have done CPA, they can confirm that. Bye bye. See you next class, God willing.